Hello and welcome to the Corporate Facilities Council's April 1st Wednesday webinar, 7 Things You Must Check to Assure You Don't Overpay the Operating and Tax Expense Invoice, presented by Carrie S. Halstead. Everyone has been muted for audio quality. If you have any questions during the webinar, please type them into the question box and we will go over them during the Q&A portion at the end of the webinar. This webinar is being recorded and will be available on the CFC's website. Carrie S. Halstead is the Chairman Emeritus of ITRA Global with experience representing users of corporate real estate in nearly 300 markets around the world. She is also the founder, president, and CEO of the longest established tenant representation and advisory firm in Pittsburgh, Pennsylvania. Carrie was recently honored as a Woman of Influence by Real Estate Forum magazine, is the acclaimed author of the monthly Insider's View to Corporate Real Estate, is a frequent speaker, and has made a number of guest television appearances.
Thank you, Anika. Welcome, everybody. Carrie Halstead here. Glad to have you all on the line. We're going to be talking about something that should be very timely for everybody. Many of you have just received your operating and tax expense invoices. We're going to be going through, as Anika said, the 7 things you must check to assure you don't overpay. So why don't we just jump right into this? We have a lot of information to cover today. First of all, learning how to protect your company against overpaying operating and tax expense reconciliation invoices. That's going to be the gist of what we talk about today. We are going to share some insights, some actual examples of errors we have found. These are not small examples. These are 6 to 7 figure examples that we're going to share with you. And we're going to reveal the 35 million reasons to closely monitor these expenses. You'll be glad to know that I'm not going to go through each and every one of those 35 million reasons. But I wanted to take an opportunity at this point to share with you that Paul Stevens, our lease auditor, is going to be joining us on this webinar today. And Paul is the one who is going to be sharing some insights about errors that have been found when we've looked into these operating and tax expenses in more detail. And just a little background on Paul. He worked for Equitable Real Estate, which then became Lease Real Estate. He was an asset manager with them for 20 years. And an asset manager for all different types of buildings, office buildings, regional shopping centers, and industrial and warehouse properties. Paul also is a certified public accountant and a real property administrator. So he'll have some unique insights that he's going to share with us today and we think are going to be very, very helpful to you. So going forward, we're going to share with you what to scrutinize, and then learn when your company is the most vulnerable, which is very important for you to know. You'll know all of that by the end of this webinar. We're going to start out with some fairly simple things and then get into some things that are a little bit more complex, and again into the case studies as well. So look forward to sharing all of that information with you. So first of all, you get your operating expense reconciliation invoice. It may look something like this. This is an actual reconciliation invoice that a client of ours received not too long ago. What we like to say is, don't look at this and just do the math. There are so many things that you can miss by just doing the math, and we've come across a lot of companies that simply look at that, do the calculations based on that one page, and mistakes can be overlooked. And we're going to share with you why you don't want to do that today and what you do want to check into. So base year. Confirm the base year is accurate and proper credit has been given for an update, if there has been any update. Here's an example of that. In this example, you can see that there's been a change with the square footage, 70,000 down to 50,000 square feet in 2015, and that remained the same in 2016. So has the base year been updated? If we look at this, we can see that the base year has been updated. It's gone from 2013 to 2015. but has it been updated in 2015? No, it hasn't. There's a mistake here, and it's really easy for this to slide back a year and not have the adjustment made when it is intended to be made. So that's something that you want to be careful of and check. When there has been any change, you want to make sure that that's reflected, not only reflected, but when it's supposed to be reflected and the amount that it's supposed to be reflected. The second part of this is confirm that the base year amount is accurate. In this example, we can see that the base year operating expenses, the base year was 2013. For the next year, the first year that there was a pass-through, these expenses were established at $7,129,296. The next year, they were the same in 2015, but in 2016, we saw a change. They actually dropped, which means this $100,000 drop, you're going to pay a percentage, the pro rata share of the building that you have of that $100,000. So when we keep track and we're looking at these on a year-to-year basis, as we do for all of our clients, it is the case that this stands out like a sore thumb, that there's a drop. And it's something that needs to be monitored. If the landlord brings it to your attention, that's great. That's extremely helpful. But if they don't bring it to your attention, you've got to catch this, that a change has been made, and understand why a change has been made. So watch out for that. That's something we just saw and something that we reviewed for a client of ours. Percentage of the building leased. Make sure the percentage of the building leased is accurate, and if there's been a change to the size of your space, the proper adjustment has been made. So again, we're using the same example, a client leasing 70,000 square feet. They did downsize in 2015. That's been changed to 50,000 square feet. Has the percentage of the building leased been reduced to reflect the reduction in the size? Well, you see that it has been reduced. It has been changed from 7.78% down to 5.55%. And has it been changed when the actual reduction took place? Well, we see that the reduction in the space happened in 2015, and also the percentage was reduced in 2015. So that is accurate, but it's something that should be checked. This is an interesting concept. Verify that the building isn't growing when the size hasn't changed, or if space has in fact been added, the percentage of the building lease has been reduced accordingly. So here's what we mean by that. It's something that we've seen in the market and we continue to see, and it oftentimes shows up when a building is being sold. So here's a building that in 2014 was 899,822 square feet. In 2015, it was the same, and yet in 2016, it was sold, and all of a sudden, it was 150,000 square feet larger, not because the building grew in size, but simply was the case that a new landlord came in, he measured it differently, and said that it was now 150,000 square feet larger. So this is the growing building concept that you really have to be careful of. Two things about this. Number one, you have to make sure that you catch this. A good lease is going to protect against this happening. Everything that we're going to be talking about today is going to be based on the lease document that you have. You want to make sure that you're covered in your lease document and that it doesn't allow for something like this to occur. But if it does occur, you want to make sure that you catch it. So this building, again, grew from 899 to 1,049,000 square feet, about 150,000 square feet. And the interesting thing about that also is the percentage didn't change. So if you have 5.55% of 899,000, it's one number. But if you have 5.55% of 1,049,000, that has increased, even though your size hasn't increased. And we're going to have Paul share the first case study of the afternoon about just that subject. Paul?
Okay. Yeah, the first case study we're going to talk about is an example of where a building actually grew. Now, this is unique because I would say 999 out of 1,000, the increase in the square feet of a building is simply a matter that the owner has just changed the square footage of the building by remeasuring, either legitimately or just they make it up. But in this particular case, the building actually grew. So what we had here was a tenant that had 67,000 square feet, and they had 21% of the building, and it's a net lease. And what happened here is that the building was actually redeveloped and it was a former retail department store building, and they turned it into a telecom center. And as part of that redevelopment, they actually added 75,000 square feet to the building. So when I did the audit, I said to the owner, well, wait a minute, the tenant square feet hasn't changed, and you've added 75,000. The pro rata share should change. And we, as a result of the audit, we actually reduced the square footage, the pro rata share, down to 16.5%. By reducing that pro rata share, the tenant saved $1,290,000 over their lease term. So again, it's really rare that there is actual construction when a building grows. It's typically just that it's made up. And to verify that, or to tell you kind of what happens on an overall basis, I did an analysis of the Boston and Cambridge markets. I took all the Class A buildings from 1997 to 2007, and I looked at the square footage in both the beginning and end of that time period. And over that time period, on a weighted average, buildings grew by 5%. So owners, over the 10 years, started adding square footage. But there was one building that grew 32%, and there were quite a few that were in the 20s. So growing a building is very common, and it's an easy way for an owner to make a lot more money at the expense of the tenant. Carrie?
Interesting. So it saved the tenant almost $1.3 million. We're talking about a huge issue there. Certainly, if you have a lot of leases, and that's found in a number of leases, you're talking about a very significant amount of money. Okay, cap on expenses. A surety cap on expenses negotiated in the lease has been applied. Here's what we mean by that. So if you have a cap in your lease document that should be applied to reduce the operating and or tax expenses, you want to make sure that that reduction has been applied. In this example, we show that there has been a reduction to the pass-through to this tenant of $2,000 just in 2015. But here's the question, and here's what we don't know in just looking at this the way we're looking at it right now. A, is the percentage accurate, and has the amount been calculated properly? And again, we have a case study about that. Paul, you want to share this case study with us?
Sure. In this case, the tenant had 17,000 feet, and the pro rata was substantially, quite low at only 6%, and it was a gross lease. And the controllable expenses were capped at a 3.5% above the prior year's capped amount. So in other words, if the prior year was $1 million, the current year could not exceed $1,035,000. It's just simply 3.5% of the prior year's number. The owner incorrectly assumed that the cap was on a cumulative compounded basis and not just on the prior year's expenses. And what cumulative compounded means is that let's say you're growing at 3.5%. And after 1 year, the $1 million turns into $1,035,000. The next year, that would turn into like $1,075,000 because it's growing, it's compounding. So the expenses for any particular year are going to be compared to that compounded growth factor. So in this particular case, the expenses for the prior year had dropped substantially at the building because they just had a lot fewer. They had fewer repairs, and the snow plowing costs had dropped off substantially. So as a result of the audit, the owner recalculated the capped expenses based on a growth rate of 3.5% from the prior year, and this saved them $245,000 over the remaining lease term. So again, it's kind of important to understand whether the cap is based on just simply the prior year's numbers or whether it's on a cumulative compounded basis. But it is an area that you should be aware of. If you've got a cap in the lease, and that's a good clause to have, make sure that you actually see that it's being adhered to. Okay, Carrie.
Great, thanks, Paul. Next, we want to make sure that proper credit for estimated payments has been made. Not only proper credit, and you might find the next part of this a little bit surprising. Beware of large refunds, and I'll explain what that means in just a minute. So if we're looking at this tenant and we're looking at the estimated payments made, in this case in 2014, the tenant made estimated payments of $87,000, the following year $80,000, and in 2016 the estimated payments were $98,000. You want to go back to your records, of course, and make sure that the estimated payments that are reflected in this operating and tax expense reconciliation invoice give the proper credit and the proper amount of credit for the estimated payments that you have made. But the other part of that is, and this is the part that most people find very, very surprising, is when you start seeing large credits at the end of the year, which means you've overpaid the amount that the landlord is actually paying for these expenses. You get so excited about receiving refunds. I mean, we all love to receive refunds. In this case, 2014, the tenant received a little over $23,000 in a refund. In 2015, the tenant received nearly $28,000 in a refund. And in 2016, the tenant received $30,000 in a refund. Here's what our experience has taught us. Don't get so excited about a large refund that you don't care anything about the actual expenses being accurate. This can happen in many cases. You just think about the refund and you don't think about anything else. So be careful of that. The other part of it is, if you look at these three refunds, they equate to about $80,000, which means the landlord had the use of your $80,000 of $80,000 period, and you did not have the use of that. Your company did not have the use of that. So we've cautioned tenants, if you're consistently paying a lot at the end of the year, the question is, why? Why are the estimates so high, and why am I paying so much money that you have the use of and I don't have the use of? And by the way, just because I'm getting a lot of money back, I still want to make sure that the expenses are accurate. I don't want to be lulled into thinking, I'm so excited about this large refund that I'm not going to check these expenses and see if they're accurate. So be careful of that issue. Operating expenses and real estate taxes, confirm they're in accordance with your lease. Again, I can't stress this enough. When we look at these leases, we look at this clause very, very carefully, because everything that we're talking about today is, it always goes back to the lease. The lease dictates the terms. So you want to make sure that you have a good lease and that it has the exclusions it should have and it has the limitations it should have. And you should always check these operating expenses and real estate taxes, the invoices, for accuracy when you get your reconciliation invoice. But there are three most critical times that you have to check into these expenses extremely carefully. And here they are. Once the base year expenses are established, remember, that sets the stage for every operating expense and tax pass-through from that point forward. So if they're not right and you're being overcharged in that year, you're going to be charged, overcharged in every subsequent year. So we always recommend a lease audit when our clients get their initial expense, operating tax expense invoice to establish the base year expenses. Number two, following the sale of your building. This is huge. If you are in a market like Pittsburgh, where you don't go a month without there being an announcement of a building being sold, which is going to impact a lot of tenants, then this is a big issue. If you have a portfolio in a number of the buildings in which you're located have been sold, or even one building has been sold, this is a critical time to do an audit. And we'll show you reasons for that in a couple of minutes here. I'll talk more about that after Paul shares some case studies in a moment here. But third, when there's a dramatic increase in building expenses, it's a great time to do a lease audit, because you want to understand why there's such an increase. And again, there should be protections in your lease that specify exactly what can be and can't be passed along to you as an operating expense. And you want to make sure when you see a dramatic increase that whatever that increase is something that is permitted to be passed along to you. And I'm going to pass this over to Paul here. We have several case studies that we're going to share with you to demonstrate these issues that I'm talking about. Paul?
Yep. The first case study is going to deal with a base year real estate taxes. In this particular case, the tenant had 26,000 square feet, which was 13% of the building, and it was a gross lease. And, of course, with a gross lease, you're trying to get the operating expenses and taxes in the base year as high as possible, because that's the number that the future year expenses will be compared to. Anyway, the lease said that the real estate taxes will be based on a fully assessed building. However, in the base year for taxes, the building had a substantial vacancy, and the owner went to the city and asked for a reduction, and they got a 19% reduction of the tax assessment, which in turn relates to a 19% reduction of the actual taxes. So in this particular case, the owner actually paid only $985,000 in taxes in the base year. However, the taxes on had there been no reduction in the value of the property, the taxes would have been $1,225,000. So by doing the audit, we increased the base year tax amount from $985,000 to $225,000. So that's $240,000 increase. That $240,000 meant that the tenant was going to save 13% of that every year over the remaining lease term, starting with their second lease year. And in this particular case, the audit saved the tenant $245,000. And one of the key things you want to remember here is that if you're dealing with gross leases, and my guess is, I mean, gross leases and net leases are really a function of the different geographic parts of the country. You'll see gross leases most everywhere. Chicago uses a lot of net leases, even for office buildings. In Cambridge, Massachusetts, which is all high-tech and biomedical research, they do all net leases. So it's very geographically positioned. But in any case, if you have a gross lease that you've signed, you want to get that base year as high as possible. However, if it's a net lease where you're simply paying your share of the expenses over zero, you want to get it as low as possible. So if this was a net lease, we wouldn't have even raised the issue. We would have let the owner leave it at $985,000 and wouldn't have done anything. So that's that case study. Carrie, the next one.
Okay.
Okay, in this one, the tenant had 18,000 square feet. It was 16% of the building, and again, it's a gross lease. And this was really odd because the owner, in spite of the fact that it was a gross lease, the owner billed the tenant as though it was a net lease. So the owner was billing the tenant for their share of all the expenses in the building, forgetting that there was a base year amount that had been established previously. So we simply identified that, and the audit established the base year amount expenses at $436,000. So the tenant was going to pay their share of any increases over the $436,000. This audit saved the tenant $320,000. And I will tell you this, that sometimes as simple as things are, owners can get them screwed up either intentionally or just by human error. But this one is not a terribly large tenant, and yet they save $320,000 over their lease term. Next one. In this one, we have a tenant. Again, this is not a terribly large tenant, 21,000 feet. It's only 8% of the building, and this is a triple net lease, so they're paying their share of any expense. They're paying 8% of all the expenses in the building. And from an overbilling status, it's easier for an owner to overbill a tenant on a triple net lease than it is on a gross lease, and I could explain that in greater detail if anybody would like to talk about it later. But in this particular case, the lease stated that the management fees, if an owner or its affiliate managed the building, the fees that they were paid could not exceed those paid to a third party based on an arm's length transaction. The owner was self-managing the building, and they charged 3%, but third parties were only paid 1.5%. This is not uncommon at all. Frankly, it's very common that an owner will charge, if you're talking a downtown tower as compared to suburban smaller buildings, but in a downtown tower, owners will charge 3 to 4% of the gross revenues, whereas if they engage a third-party management company, be it JLL or CBRE or any of the majors, they'll only pay them 1%. So in this particular case, we noted it to the owner that in spite of the fact that you want to pay yourself you can pay yourself 3%. I don't care if you pay yourself 5%. But what you can only charge to the tenant is what third parties are being paid. And we had plenty of documentation that the third parties are being paid 1%, but in spite of that, there's always negotiation. And as a result of the audit, the owner agreed to only charge 2%. So in this particular case, this audit saved the tenant $203,000 over their lease term.
Great.
Next one. Oh, this one. Oh, this is a good one. Now, this is a large tenant, I would tell you that. But one thing you might want to think about is, in spite of the fact that it's $275,000 with 47% of the building and a triple net lease, and the savings are huge. If you have let's say you're a 27,000 square foot tenant, it just simply means that you're only going to get 10% of the savings, but the savings are still substantial. And in this particular case, there was a parking garage at the building. It was a big public garage that was attached to the building, and the lease was absolutely clear that no operating expenses or taxes related to the parking garage would be passed on to the tenants. However, the owner excluded pretty much everything. I mean, they excluded the costs of the people working at the garage. They excluded the cost of the electricity being used there. They excluded the cost of any maintenance on the 1 or 2 elevators that were in the garage. So the owner actually did a pretty good job. However, they did forget to exclude the management fee that is generated from the revenues at the garage. So being that this was a really large parking garage, those revenues were included in the management fee calculation. And when we pointed that out to the owner, they said, okay, we'll agree to delete these revenues from the management fee calculation. I will tell you this is also a very long-term lease, but in spite of that, it's still the tenant is saving $3.4 million over their lease term. But as I mentioned earlier, if you said, well, gee, I'm not that size tenant, I don't have half a building, okay, so you got 27,000 feet, which is about 5% of the building, that would have saved you $340,000 over the lease term. So it's all relative, but there's I can assure you that when an audit gets done and you save that kind of money, it pays for a lot of water that you're going to buy in your offices. Carrie?
Good point.
Oh, and by the way, just back up on that last slide if you can, if not. Another point is that in spite of the fact that we do audits and the owners say, you got me, I won't do that again, it's a good part of the time, the next year they do the same thing. Now, again, whether it's done deliberately or just human error, I couldn't tell you. But I did that audit. This audit was done here in 2016. I've already started the 2017 audit for this particular owner, this particular tenant in the same building. And the owner has done the same thing. They've included in the management fee calculation the parking garage income. So we're going to get, we're going to get the money back again. Okay.
Interesting.
This one is going to this example deals with the gross up of expenses and the errors that occur there. In this particular case, the tenant has 31,000 feet, which is 18% of the building, and it's a gross lease. For any of you who are not familiar with the gross-up clause, this is a very, very common clause in virtually all leases. And the concept is, and it'll say something like this: if the building is less than 95% occupied, operating expenses, which vary with occupancy levels, will be adjusted to what they would be at 95%. So let me give you an example. Let's say that a building is 50% occupied. It's a 100,000 square foot building, and 50,000 square feet are occupied, and there's a 95% gross up clause, and cleaning contract is $1 a foot. So since you had 50,000 square feet occupied in that year, there would have been a $50,000 payment to the cleaning vendor to clean the tenant and the common areas. That clause then says, well, but what would that cost be if it were 95% occupied, or 95,000 square feet was occupied? And in that case, the number should be 95,000. So what you would see is there would be the amount on the general ledger from the owner would say that they actually paid 50, and then there's this accounting entry, so to speak, of 45,000 to get you to the 95. I can tell you this, that if it's done properly, the gross-up clause is fair to both the owner and the tenant. It's just a matter of, it sort of levels the playing field for the tenant when you're going from low occupancy to high occupancy during your lease term. On the other hand, it levels the playing field for the owner when you're going from high occupancy to low occupancy during your lease term. So in the first example, it just sort of, the tenant is sort of saved, and in the second example, the owner is saved. So it's a fair clause. Well, anyway, in this particular case, the lease said that if the building was not fully occupied or 100% occupied, then operating expenses would be adjusted to what they would be at the fully occupied amount. And the owner made a lot of mistakes, and they're very, very common. They just use the wrong concept. They use the wrong average occupancy. They use a lot of things wrong. Anyway, we increased the base year by $173,000, and that saved the tenant $236,000 over their lease term. Carrie? This is another same concept. This is base year expenses, and in this particular occurrence, the tenant had 25,000 square feet, 13% of the building on a gross lease. And the lease stated the operating expenses would be based on the incurred method of accounting as compared to the cash method. Incurred simply means you've incurred a cost, even though you're not paying it, you still got to record it. The owner did not record 12 months of expenses for virtually most of the expenses, and of course your big expenses that they didn't include incur for 12 months would be your cleaning contract, your security, your utilities, electricity in particular is always back billed. I mean, your electricity, like for, let's just say from September 1 to September 30th, the utility may not send out the bill until October 15th or 20th, and they say it's not even due until November 10th. And in this particular case, we were able to change a lot of the expenses to reflect 12 months of expenses, and we increased the overall expenses by $235,000. This saved the tenant $276,000 over their lease term. So it's just those are the things that happen in base years, which if you go back a few slides, that's where Carrie noted that, that's one of the 3 times that you really, really ought to think about making sure that an audit is done just to verify that the base year number is correct. Carrie?
Good. Thank you, Paul. Interesting. So I promised that I would get back to this, and this is one of the most critical times to do an audit. If your building is sold, understand that there can be glitches that can occur when there is a new building owner or different software. I can't tell you how many building owners I've talked to who have said to me, Carrie, I'm having a heck of a time getting information from the previous owner. I'm struggling with this, and that can present problems to you. And who among us hasn't gotten new software, and when we do, there are problems? I don't remember ever getting software when there hasn't been a problem. So, you know, there could be software issues. There could be glitches with a landlord who is passing on information to a new landlord. But be very, very careful when your building is sold. This is a really good time for mistakes to occur. So that's the end of our presentation. You should know at this point how to protect your company against overpaying operating and tax expense reconciliation invoices. We've shared insights. We've shared actual examples of errors we found. And when I referenced the 35 million reasons at the beginning of this presentation to closely monitor these expenses, the reason I said that is because our lease audits have found $35 million in mistakes to date. That means that when we've gone in and we've audited these leases, it is the case that tenants would have had to pay $35 million more had we not audited these leases than they paid as a result of us auditing these leases. So this is a huge issue. You want to be very careful. We wanted to take an opportunity to share some concepts with you, but also some examples of where errors have been found. And then also, you know, again, what to scrutinize and when your company is the most vulnerable. And just as a final reminder, the 3 most critical times to do a lease audit is once the base year expenses are established. Again, this establishes a base year amount for every year after the lease, and you want to make sure those are accurate. Following the sale of your building, and when there's a dramatic increase in building expenses. So at this point, we're happy to take some questions. Paul, why don't you and I take a look?
Yeah, I see one question over here. The question is a cap on operating expenses typical in a lease? And if so, what is the typical percentage you see? The answer is it's not that typical. It's a great clause for a tenant. That's why owners don't want you to have them. But to the extent that you are able to negotiate a cap, and that's always a function of, you know, who's got the leverage at the negotiating table. If you're if you're taking 2,000 square feet in a tower, the answer is you're going to sign whatever they put in front of you because you have no leverage. Whereas if you're a larger tenant in the building, not necessarily square footage wise, but percentage wise, then you have more leverage to try to get something. As far as a typical percentage, what I see is owners, if an owner is going to give you this, they're going to want to make that cap as high as possible, 5-6%, maybe a little bit higher. If I'm a tenant, I would like to see something more in line with where I think inflation is going to be, which is 2.5%, 3.5%. Carrie, what do you see?
Paul, I agree with you, and that is completely negotiable depending upon the leverage that you have at the negotiating table. If we're negotiating, for example, a headquarters lease, and we did a headquarters lease for a utility company not too long ago, and we were able to get a cap on expenses, and that cap was 5% per year, and it was on the controllable operating expenses. What we're finding, however, as markets tighten and rental rates go up and the amount of opportunities diminish that the tenant has, then it is the case that we're seeing less and less in tightening markets of those caps on expenses. And again, they're typically not on real estate taxes, but they are typically, if you can get them, on operating expenses. And that's it's the case that we're seeing on controllable operating expenses, not on all operating expenses, but the controllable operating expenses. But through the years, we're seeing those diminish. We have a situation here in Pittsburgh where vacancies have declined for the last 10 years. And so for the larger tenants, there are not a lot of opportunities for large blocks of space anymore. So what we could accomplish a few years ago and what we can accomplish now is a bit different, but you can find exceptions to that in some cases. And we always know that we don't get what we don't ask for, so we always ask for it. And in some cases, we're successful in getting it. But again, the markets are tightening, and I wouldn't set that as an expectation. But if you have it, and they're more common in older leases, make sure if you're in charge of reviewing these reconciliation invoices that you recognize that you have that and that it's being applied properly, both in terms of the amount and in terms of how it's calculated, as we pointed out earlier.
Carrie, I see another question, and this one is, how many years can you typically go back if you find an error, or is that dependent on the lease language? Well, the answer is it's totally dependent on the lease language. Typically, here's what you see as far as the audit rights. The leases will normally say that an owner will provide a year-end reconciliation of the prior year's expenses within 90, 120, 150 days after year-end. At that point in time, once the tenant receives that reconciliation, the lease normally says that the tenant has anywhere from 30 to 90 days in which to give an audit notice if they want to do an audit. So if you think something is up and you want to do an audit, then you've got to do it within that window of time. But as far as how many years you can go back, and typically, I'm going to say it's 99 out of 100, only allow you to go back for the year that just passed. Sometimes I've been able to do audits where they, at some pharmaceutical firms, large pharmaceutical firms that had a lot of the buildings, so they had more leverage when they did their lease. And they allowed the audit, if you found something in the audit, they allowed you to go back another 2 years. So in effect, it was almost a 3-year audit. You could only go back at those 2 years on any specific thing you found during the audit. So if I was doing an audit of the 2016 expenses and the management fee percentage was 3% and it said it should only be 2%, not only did we get the tenant money back for 2016, but we would go back to 15 and 14. That's not common, but it can be done. I will also tell you this, that in spite of the fact that the lease would say something like, well, if you don't send the audit notice within 90 days, you've lost your right. Never accept that concept. You always ask for the audit. The worst thing that the owner could tell you is forget it, get lost. But if they do tell you that, then you just say, when you ask for the rights, you could say something like, look, I know that the lease says that we've missed our 90-day window, but in the spirit of good owner-tenant relations, we would like to do this on a one-time waiver. I would say we've been successful 3/4 of the time using that same concept. So the fact that you may have passed on the audit window, that should not stop you in any way from at least asking for an audit right.
Good point, Paul. Paul, you mentioned something else. I don't see another question here, but maybe you could expand on the issue that you were talking about earlier, and you said, I'll expand on this if we have time at the end. And I'm sorry, I didn't write that down. Do you recall what that was?
It wasn't gross up. Maybe go back on the...
Yeah, I think it was the difference between gross leases and net leases.
Yeah, oh yeah, and why it's, yeah, okay, let me explain this. Okay, let's do net lease first because it's the easiest concept. Let's just say that you have a net lease and you have 10% of the building, which means you're going to pay 10% of the operating expenses in the building. And in the first year, because with a net lease, you start to pay your share of the expenses from day one. And in that first year, and we'll say the first year was calendar year 2016. The owner had a management fee of, he had a management fee of 3% that he charged, and he could only charge 2%. And that excess amount that he charged was $100,000. So your share, that 10% share of that is $10,000. So if you don't do an audit and catch it, you're going to pay $10,000 more than you should have paid in year one. And year two, with revenues going up, it's probably going to be $11,000, and in year three, it's going to be $13,000, something like that. Now let's go to a gross lease. And let's just say that the 2016, because it's a gross lease, is the base year for operating expenses. And included in that base year is the 3% management fee. Now, if the 3% management fee is in the base year, and it's in the second year and the third year and all your years of your lease, in theory, you aren't really being harmed that much, because all you're doing is paying your share of the increase in that expense from year to year. So if the 3% number was $100,000, it was $300,000 in the base year, and the next year it's $310,000. All you're doing in year two is paying your share of a $10,000 increase, and you're not harmed by that much. And in fact, part of that if you go from the 300 to 310. And if the owner had done it correctly, it should have been maybe 200 to 207, because you would have had a 2% management fee. In the correct way, you would have paid your share of a $7,000 increase, or $700, and in the incorrect, you're paying your share of a $10,000 increase, or $1,000. The difference is $300. This is why if you have a net lease, it's automatic. If something is wrong, you're going to save money over the lease term immediately for something that's done wrong. With a gross lease, if it's done wrong, but it's done consistent, you're really not harmed that much. And any owner worth his salt will, if I went to an owner who knows anything about real estate and said, hey, we got a 3% fee and it says you can't be more than 2, and I want my client to get 10% of that $100,000 back, and he's going to say, well, wait a minute, the base year had that amount too. So any owner who understands real estate concepts is going to say, look, you haven't been harmed by that much, and the best they would do is just go back and they say, okay, we'll change the current year from 3% to 2%, but we're going to change the base year from 3 to 2, and now you're comparing apples to apples. And anyway, that's the math of it. It's why a net lease is always a lot more potential savings for a tenant. When people ask me what size tenants, are auditable, or what are how big do you have to be? First of all, in my opinion, the size of the tenant is not nearly as important as the pro rata share of the tenant. So, a 100,000 square foot tenant in the Empire State Building is virtually, they're lost. It's meaningless. I actually have a client that has 100,000 feet in the Empire State Building, and we don't even do an audit because they have such a small share of the building that we'd have to find gigantic overcharges before they would, benefit. But when it comes to the Carrie, I'm losing my train of thought here.
Oh, you were talking about the percentage of the building. That's a bigger driver than the square footage.
Yeah, that's a bigger driver, and I think that that's when you decide whether an audit might be advisable or not. But if I compare a 10,000 square foot net lease, if I had a 10,000 square foot net lease client, to me that's comparable to maybe a 25 or 30,000 square foot gross lease. So it depends on whether it's gross or net as far as how much you can get back. But a net lease is a lot more opportune for an owner to overbill, and a lot more opportunity for a tenant to actually get cash back. So I think that answers that question.
I think so too. That's great. So the bottom line, the lease audits that we showed you examples of today have saved tenants between $200,000 and $3.4 million. And I reiterate that, you've already seen it as we've gone through the case studies, but I reiterate that to put this in its proper context, this is a big issue. It can cost your company a lot of money. And in total, we have found $35 million in mistakes so far as we've gone through these lease audits. That's what I wanted to share with you today. Hopefully we've given you some really great information that will help you and your company save money when it comes to operating and tax expenses. And if nobody has any other questions, we want to thank you for attending today. Have a great question. You have my contact information there. If you think about this a little bit and have any other questions, don't hesitate to send me an email and we'll get you an answer. And Paul and I have enjoyed making a presentation to you today and hope you have a great day. Anika, thank you for setting this up, and appreciate your help today.
Thank you. Bye-bye.
Thank you. Bye-bye. Bye-bye.
Terry, I don't think they'd be able to read that.